in this backdrop, this CF, I don't want to say the word, this mess, we've got really massive weaknesses in the bond markets and the stock markets and in the labor markets. And if you look at the bond market, it's everything. To me, if you understand the bond market, you can understand all the other markets. And what we have is rates and yields are rising. That's a very bad thing in a debt crisis, in a debt backdrop. And interestingly enough, as rates are rising all over the world, but certainly in the US, the DXY is actually going down. That's like a banana republic move. It's not an interesting or good sign. And interest expense, even before the war in the US, on Social Security, Medicare, or on our US Treasury debt, was 20% higher than our tax receipts before this war. And now when you add in a $1.5 trillion military budget, we just don't have the revenue, the income, the tax receipts, the GDP to save that bond market naturally. And what's a little wonky is the net international investment position of the US, its piggy bank outside, is negative 80%. That means as we're heading into a crisis in the US bond market, 80% of our assets are held outside of the US. When there's a global crisis, for whatever reason, other nations which hold a lot of our treasuries, dollars, and other assets, including stocks, they need liquidity. They dump those assets, including US treasuries. That sends yields higher and interest rates higher at a time when we are broke. So the bond market is a massive red flag right now. The stock market, which is complacent like in a twilight zone, again, was pricing in a quick war. In my opinion, and it's my opinion, but it's shared by more people than just the gold guys. It's Ray Dalio, it's Jeremy Grantham, it's Goodlack on the bond market too, is that at debt levels this big, something does have to break. I think it will be the S&P and the Dow and the NASDAQ. I think rising rates equal tanking stocks. I think where we're going to see this implosion in the stock market, again, in the backdrop of this crazy conflict, is probably in private credit. I'm not alone in that. Even Jamie Dimon is openly warning of the risk of these over-levered credits. I think the AI will save us. Hype is the exact opposite. I think AI couldn't come at a worse time for our labor markets. And when I look at the stock markets as a former hedge fund guy, people have to realize that when you see widening credit spreads, that is a 100% red flag of a bear market coming. So the bond market and the stock market and the job market are pricing in a lot of pain. And I think the other big risk here is the net loss of jobs. It's not like our Bureau of Labor Statistics or our labor data is getting better. It's getting worse. We've had 13 consecutive months of revisions. We've got 92,000 lost farm roll payroll jobs recently. And we have to remember that in 2025, as we ended the year that came into this war year, not only did we not see a net increase of jobs in the US, we saw a net destruction of jobs. So that's like another massive signal in this. We keep that in the context of this. And to your point earlier, Alex, even Jerome Powell, who clearly is no friend of Trump right now, has less fear to just say the quiet part out loud, the elephant in the room. Our debt levels are way beyond our income levels. It's no longer sustainable.